I'm sitting down for a chat today with the Chief Investment Officer of Lakehouse Capital, Joe Magyer, who has been investing long before he could even drive. Joe and the team have enjoyed pretty spectacular returns since launching. Both his global and his Aussie fund have returned more than 25% per annum since inception. The last 12 months have been no different. Both the funds have returned more than 42%, which is pretty impressive in my book. Thank you so much for joining us today, Joe. I'd love to start off with how you actually got into investing in the first place.
Sure. Well, I was very fortunate to get started at an early age. When I was a kid, I spent my summers at my grandparents' lake house. My granddad was a successful entrepreneur, retired very young, and in his free time built a cabin where we all stayed and spent our summers there. So while most of the kids would be out doing like swimming or shooting BB guns, which is all the wild things American kids do in the mountains by a lake, I would spend most of it hanging out with my granddad and talking about companies and businesses and why he was invested and his approach to investing in business and life overall. And it was a really great experience that just sparked a lifelong passion for the craft.
It actually inspired the name of the fund, didn't it?
It did, yes.
Yeah. I mentioned your fund's return since launching previously. What's your secret? Can you take us through the three pillars that you use as part of your investment strategy?
Sure. Well, with the philosophy, there's really three. So the first is that we're long-term investors. We believe putting time on our side in a very evidence-based way. The truth is that when you look at study after study, they all show the same thing, which is that investors who trade less, on average, have better performances than who trade a lot. And that's true across different time horizons, markets, asset classes. So it's really just putting the evidence on your side. And I'd say that's, I think, all the more true as time goes by, because more and more of our competitors are becoming progressively focused on short-term tactical edges, and I think it makes the value of a long-term perspective that much more useful. The second is that we're high-conviction investors. So we believe in backing our best ideas, knowing a smaller number of companies really well. Again, it's evidence-based, so it's intuitive in the sense that if you own dozens and dozens of companies, you're probably not going to know them very well. But when you look at the evidence, which shows that fund managers who, on average, are more concentrated outperform those who aren't. So it's really just a matter of backing our best ideas and making sure we're putting the odds in our favor. And the last thing would be that we're looking for asymmetric outcomes. So to put that in English, we're looking for multiple ways to win and a few ways to lose.
You mentioned that it's a big universe of ideas out there, particularly given we're in Australia and there's a lot more ideas globally. How do you find ideas within this giant universe of stocks?
Sure. So to your point, 98% of the world's equity market value is outside Australia. So, and there's plenty of really good opportunities here, so it just underscores like the size and the universe. We approach it a different way from most other investors. We take what's called a Fascinations-based approach, and the way we came to that was, when we were putting the team together, we were assembling the team. We thought about, what is the big goal that we're trying to achieve here, and that's long-term outperformance by backing a high-conviction group of companies that we think can reinvest at attractive rates for a long time because they've got strong competitive positions, really attractive reinvestment runways afforded from that, able aligned management teams who can run with it, really good unit economics. Well, as it happens, most companies that have all those traits tend to have similar business models. So there's not necessarily a correlation around what sector they're in or what country they're based in, but they tend to have one or more of unique and enduring intellectual property or IP, network effects, or extremely low customers. And so when we built out the team and started to focus on, how are we going to put ideas in the top of the funnel and work them through, it was, well, let's base it around those business models that we think are aligned with long-term outperformance, or at least put you in the best place to get that outcome. So we have, IP networks and loyalty as our core investing fascinations, as we call them. Every idea that comes to the table comes through the lenses of those business models. It's less running traditional screens and more about identifying truly differentiated businesses with those unique models and working our way through the ecosystem around them.
With that in mind, do you prefer intangible assets or companies with intangible assets or tangible assets?
Great question. Great question. Definitely intangible. Even where we have companies that do make things. It's few and far between, but I'll take a Monster beverage. So Monster, you've all seen the big green can. The reality is, though, that business is still very capital light because the value isn't people. The value in the business is really the brand at its core. So people look at Monster, and I appreciate that Monster may not have the same. It's not Monster and vodka. It's Red Bull and vodka, and I think Red Bull has done a nice job of carving out the more premium end of the energy drink market. But Monster has been gaining share from Red Bull for many years globally across almost every market. And there's still a lot of room to run with that. And the brand speaks to a lot of people. They have fantastic margins, excellent returns on capital, and it really is in that differentiator with the brand that stands out. I think businesses where it's based on hard assets as your advantage, that's typically a cost advantage. Those things are harder to hang on to, and over time they tend to get eroded. They're a little more open to disruption. And they tend to be more cyclical with worse returns on capital.
I feel like everyone in the market is talking about the upside for value and cyclical stocks at the moment. As a growth manager, how do you position your portfolio with this in mind to come out on top?
It's a good question, and I think it's important for investors to have a really clearly defined philosophy and process. And you have to know there are times where your approach is going to be more successful, but just be comfortable with the fact that you are going to have periodic bouts where things may not necessarily be going your way. So right now you're seeing a really strong rally in cyclical companies, which collectively have historically low returns on capital, volatile returns, not places that have generated a lot of wealth over a long time. We're very comfortable not owning those companies over a long time for that reason. They don't align well with our time horizon. And I think that's fine. Like if some people are trying to do that, but the thing is, that's not the long-term, fundamentally driven strategy that we're pursuing. That said, I think that within the context of growth, there's certainly a lot of range. So within the past few months, we've taken profits on a few different positions that, particularly kind of that mid-cap software as a service business model, which treated investors very well, but share prices rallied pretty hard there. And so we've taken some profits there, and I would say we probably preserved capital given how growth has come off a little bit lately. But also, when you're working with a global mandate, as we are, you've got tens of thousands of rocks that you can turn over, and there's a big universe of companies where you can always just be trying to find something new. So, yes, you might be, running into valuations being high in one part of the market, one sector, one geography, but it's a big world and there are a lot of different opportunities.
Yeah, for sure. Inflation has also been on the tip of every investor's tongue at the moment. Is there a stock in your portfolio that you think will really benefit if that comes about?
Oh, yes, and I think investors are right to be conscious and thinking about inflation right now. You've got ultra accommodative fiscal policy globally, monetary policy, you've got QE, very low interest rates, and as the world reopens, there's likely to be a lot of spending that takes place. So in 2020, it was the highest rate of savings, household savings ever in the US. So there's a lot of money that could be put to work. When you look at the money supply in the US, over the last, since 1943, we haven't seen as big a year-on-year change in the money supply as you saw coming out of 2020. So there are a lot of reasons to think, and Jerome Powell basically changing moving the goalposts on the Fed's approach to inflation, and basically be willing to accept a higher risk of inflation running hot in order to drive growth. So I don't know how many more things you need to stack up to be concerned about it. The way we think about that is, all the companies that we seek out have pricing power as one of the core traits that we're looking for. There's a lot of inbuilt protection in terms of what we own. But beyond that, more than half the companies we own have business models tied to the value, directly tied the revenue model to the value of what flows through their business. So that could be payments, it could be marketplaces, it could be advertising, but they clip the ticket on the value of what goes through, which builds in a very aligned protection against inflation. I think a good example would be Visa. So this is a business, one of the first things we bought at the fund. We bought more of it recently, so it's a core long-term holding for us. Visa's network is incredibly powerful. It's the world's largest. And in terms of inflationary protection, if inflation runs away, particularly if it's because of a strong economy, Visa's incredibly well placed to take advantage of that. The other things I'd say too are that there was, while obviously everything with COVID is tragic, there are some businesses that benefit, right? And in the sense that more online spend is good for Visa because they have more share of online than offline spend. And offline, more spend has gone from cash, which was something like 85% of the world's transactions pre-COVID were still cash-based. More of those are going to plastic, which benefits them. And one last thing I'd say with that is that there's kind of this traditional, there were a lot of people ask, what does buy now, pay later mean for Visa? Is this a threat? It's actually a revenue positive for them because almost all those transactions end up flowing through cards. And instead of one purchase, it's really split into four. So, they really just get more bites of the cherry. So, it's a business that we think is structurally really strong long term, but we feel really good about the next couple of years as well.
In the current low interest rate environment, valuations have run really hard, particularly for growth stocks. What happens when a stock, I guess, the price has become higher than your expectation? How do you manage that?
Yeah, it's hard because as a growth manager, the whole premise is that you want to let winners run. And if you just take quick profits over and over, what you end up doing is owning all the businesses that didn't work out and, and some cash. But it's not a fruitful strategy. So you have to balance, that said, you want to let that happen naturally, but you have to be conscious of valuations. And, in some cases, some of them got fairly stretched. And I'll give you an example of something we sold recently, which is M3. So M3 is Japanese. You think of it as a Facebook for doctors. It's a very quirky business, but what M3 does is they got this massive social network of doctors that allows them to sell ads, job placements. There's a lot of basically a whole ecosystem of selling into doctors and the value chain that flows through this really dense social network. When we invested, it was selling at about 9 times forward revenue, which I appreciate. For someone who out there buys conventionally cheap stocks, may sound expensive, but very high quality growth company and in a market where interest rates have been near zero for 2 decades. Over the course of the time we owned it, we averaged up when the thesis was proving itself out. Then later took some money off as valuation started to get stretched. Ultimately fully exited when it was selling on 36 times forward revenue, at which point we just couldn't really justify hanging into the position anymore. But to get back to it's a big world, there are a lot of opportunities. We found another business also in Japan that we thought offered basically a higher growth prospects with really attractive economics and selling at about 30% of the valuation that what we just sold with M3. So we're not in the business of flipping from one business to another, but we're rational people, and when we can find a better opportunity that offers comparable growth for much better valuation, we're going to take it.
I think you're talking about Sansan, is
Yes.
that correct?
Yeah.
Could you take us through how you used your 3 pillars of investment strategy to actually buy that company?
Sure. So with Sansan, I'd say you've got to, and I'm guessing virtually no one watching would be familiar with them.
Yes, I have no idea what it is.
So the core of it is it's a contact management system that starts with business cards. So business cards are still a very big cultural element in Japanese business. Even despite what's been happening with COVID. So, a lot of relationships begin with business cards, but we've all probably got a stack of business cards at the office or at home, that's like...
That we never look at.
Yeah, it's huge.
Yeah.
You never look at, and from a company perspective, that's a lost opportunity because you've got all these contacts, great information, and really, those are the company's relationships, right? But they're not categorized and kept. So what Sansan does is you might get a business card. I give you my card, you whip out your camera, you take a picture, and AI basically snaps all the information and puts it into a database with the company so they can track who's met with who, they've got the contact information, and it's kind of the base layer. But really where it starts to get more valuable is it becomes more like a Salesforce type offering. So it's not just keeping up with who knows who and what information, but who's met who should talk to who, and it becomes more of a, a system of record. And when you look at retention rates, something like 93%, which is incredibly high, and that's actually up over the past couple of years, which normally when a company is growing at very high rates, you see retention kind of go backwards. To see it going higher, we think speaks really well to the value prop. I guess one more thing I'd throw in too is, well, two things. They also happen to have the largest professional network in Japan, which is 8. They haven't done much to monetize that. They've just been focused on building it out and driving engagement, but that's a really nice call option to have in your back pocket. It's actually larger than LinkedIn in the country.
Oh, wow.
And when we look at the valuation of the business, we basically paid at initiation around 10 times forward revenue for business with gross margins in the 80s.
The portfolio has an average turnover of around 13.9% since inception. Is it possible you could take us through the benefits of this kind of low turnover approach?
Sure. So, when you distill it down, I think a low turnover approach really has two big benefits. The first is that when you look at research, studies show that trading less on average leads to better outcomes. So you're just increasing your odds of a good outcome just by being patient and not over trading. Second is, and I think this is kind of underrated, but knowing your companies really well. So during COVID, what we saw was that, I saw an interview with a fellow fund manager who was touting that everyone on their team had worked around the clock, basically through the whole stretch to try to re-underwrite all their investments. And while admirable, and it sounds great because everybody loves hustle, I would say it would have, respectfully, if they'd had a tighter handle on some of their companies from the start, they might have been able to conceptualize those things better. And part of that is having a higher conviction portfolio, where it's just tighter and there are fewer investments. But part of that is turnover driven. And if you think of it as a typical global fund manager in Australia, the median number of holdings they have is around 60. We have 20. So if you're thinking about how hard it is to stay across 60 companies, and if your turnover is something like 100% a year, which is common with a lot of active managers, imagine you're a PM portfolio manager, who has to basically relearn the investment case for 60 companies every year, right? Like, you're just not going to know those companies well. You're not going to have a lot of conviction. When things get challenging, you're probably not going to hang in there, which just kind of feeds on itself. So,
is 20 the sweet spot then, or would it be slightly less?
Yeah, it's a sweet spot for us. It's enough that we feel like we're diverse enough that we're not losing sleep over sizing, but it's high conviction enough that when things go well, you actually feel it, the performance in the portfolio.
There has been kind of this explosion of day traders over the past 12 months. Is there any advice as a long-term investor, especially in the growth area, that you would give to these people?
Don't. So I saw a study once that 80% of day traders lost money over the course of a year. I think they lost over 30% on average. It's a very challenging way to attempt to make money. You're going to ring up a lot of brokerage costs, or even if you're trading for free, you should know that your broker is probably selling your order flow and you're getting bad prices, and that's why it's free. Nothing's ever entirely free. And again, just study after study shows that it's a losing proposition. And yes, maybe one out of a very, very small number of day traders might succeed, but why would you pick such a statistically improbable way to invest? When clearly all the data shows that if you go in the other direction and put time on your side, you're more likely to have a good outcome. So, I just say maybe slow down a little bit. Think about trying to put odds in your favor, being a long-term investor. Think about what you own. So if it's just ticker symbols to you, then that's a problem, because a share isn't just a lottery ticket. It is a living, breathing business. It's a claim on the assets and earnings of that business. And I think it should be treated like that. I guess the last thing would be to diversify. Too many, I'm sure you've heard them, but you always hear sad stories about people who kind of put everything into some specky stock and get crushed, and that's terrible. There should be more financial education to help avoid things like that. But you need to diversify and make sure you're not overextending yourself. A lot of people come to me, like barbecues or kids soccer practices, and you start talking about the market, and they're always looking for one big tip. And I'm like, look, really, that's not how people get to their goals. It's methodically saving, spending less than you earn, saving that, put it to work, put it in businesses you're going to own for a long time, and more or less leave them there and don't get in the way of compounding. And it's also basic that I think people can overlook that, but it's probably the single biggest thing that individual investors can do to further towards their goals. So.
Our audience loves a good statistic. Is it possible you could take us through something that really has surprised you or impressed you in the past few months or the past few days? Something amazing that you think could shock investors and our viewers?
Yeah, it's a funny one, which is that over the long term, only about 37% of active managers outperform their benchmarks. And I think that's fascinating because once you get inside the machine, and you've tons of fund managers, what you come to learn is they're all very smart, all very well educated, great training. They've got Bloomberg terminals, FactSet, they've got research tools, company access that individual investors do not have. You've got analysts supporting you who are wicked smart, hustling, trying to climb the ladder themselves. So on paper, these people are all set up to succeed, and yet most of them don't. And I think I think a good question is why. And I think it really boils down to that most strategies and investment products are not designed with performance for the client being top of mind. They can be a little more around kind of investment manager corporate risk. Another thing is when you look at research, it consistently shows that investment managers' best ideas, on average, really do perform best. So the number one weighted position in the fund delivers the best performance, followed by number two and so on. So it's intuitive and it makes sense, but then why do people stretch past, out into 60 plus holdings? I've never met a client who was like, quick, tell me your 60th best stock idea, right? So I think that if investment managers were more willing to back themselves, I think they could end up with better results. And I think probably be a good question for more clients to ask is, how many companies do we own in this fund? Why do we own this many? How is that beneficial for us clients?
Well, it's been an absolute pleasure to talk to you today, Joe. Thank you so much.